Hello, everybody. Welcome to another Friday Talk Money with Tom show. Our objective is to try to help you have a more successful retirement. We do that through answer your questions. So you can send in questions during the show in several different ways. You can send them via email to the Ask Tom with talkmoneywithtom.com address you see here on the screen. You can enter them in the chat if you'd like, and we'll try to answer those questions live. You can send in those emails during the week, which we get on a fairly regular basis, so that's very helpful. It gives us a chance to think about the answers. And then, of course, we cover some of the subjects that came up within our strategy sessions with the clients. So we really believe within our clients and really in the general public here that the best way to improve your retirement experience, especially financially, is through education. The more you know about asset management, retirement planning, tax management, those types of things, really the better chance you have of having a financially successful retirement. So we've created this channel, Talk Money with Tom. We have over 900 videos on here now, so feel free to browse those. But you can also subscribe by hitting the subscribe button. Little bell next to it you can hit to get notified when we put new content on. And that way you can kind of keep up with what we're doing as far as that goes. And then lastly, you can always schedule an appointment with Ethan and I. You go to our website. The link is here on the channel. You go up in the top corner of the homepage. You'll see a button that looks just like that. And that's, click on that and you can pick a 30-minute phone or video appointment to meet with Ethan and I. Maybe cover something more custom or personal to you. See if we can help you with that. So really hope somebody gets something good out of today's show. We always try to cover, I think, interesting subjects that are helpful, but maybe one of them really resonates with you as far as that goes. I do always like to start off the show with a summary of kind of what I saw happening in the market this week. So what I have here, of course, is a chart of the S&P 500 going back to the beginning of the year. And then the blue line that's in there is the average for the 200 days prior, and you can see where that's going. So altogether, obviously, the price is down. The 200-day moving average has started to come down. But if you look at this week, we've got quite a few little green boxes there coming up. It's actually been quite a good week with some interesting things that are happening. One of the things you do have to be careful about with this week is just that it's a holiday shortened week. And often volume is lighter, and so we might not really see trends that we want to pay that much attention to until maybe next week. We did see some lighter volume here because basically what happens in lighter volume is that you can get a smaller group that's pushing the market one way or another as far as that goes. But we did have some interesting information come out this week in terms of economic reports. We call this Employment Week. So earlier this week, they put out the first-time unemployment claims. It was 235,000 people that applied for first-time unemployment. Last week, prior to that, was 231,000, so it's a little bit higher. It's been coming up slowly but surely over the last several weeks. But the expectation was actually that we would have 230,000 new filings. But the market actually went up, right? And this is the weird part about where we are right now in the market. So bad news, like higher unemployment, can be good news to the stock market, and good news can be bad news. And the reason is because we've got this situation where the labor market, for example, is very tight and inflation is very high. And so if the labor market softens up, where you have a scenario, with more people unemployed, that actually could take some pressure off of inflation, and that could allow the Federal Reserve to become a little bit more accommodative, and the market would really like that because right now the Fed has been incredibly aggressive in their conversations about raising rates and what have you. Well, today we kind of had the opposite report. We had the jobs report, which shows how many jobs were created in June, and it was 372,000 jobs. The expectation was 250,000 jobs. So a lot more jobs were created than expected. Again, normally this would be good news in the sense that, the economy's doing well and things are picking up. In this environment, it creates a tighter labor market, and that's what the Fed is really, one of the things they're trying to focus on. There's over 11 million open jobs. There's almost 2 open jobs for every person looking for a job, and that creates a higher inflation on the wage, which eventually comes through higher inflation on price. And so that's what the Fed is fighting really hard right now as far as that goes. And so I think what happened today will allow the Federal Reserve to be more on the side of doing another three-quarter point increase. And we've seen some market movement towards maybe a half a point increase, but this labor report was pretty strong, so we'll see how that plays out. Next week is a really big week because that's when the CPI index comes out. And if you look at this big waterfall of red that happened a few weeks back, that was the last time CPI came out. And so the May inflation report that was reported June 17th came out higher than expected and actually was the highest for the year at 8.6%. So what will this week be? I actually think this week will be lower just because gas prices in June were moderated, and maybe that actually is a catalyst to the upside. We'll see what happens. And so, again, bad news is good in this environment. So as things slow down, that's what needs to happen here. The real question will be, does it slow down too much, right? And so that's the big battle. There's so many cross currents going on right now. It's unbelievable. Things that are, people look at this jobs report today, 372,000 jobs. They said, oh, that's a sign that we're not in recession and we're not going to have a recession. Another group looks at that and says, oh my, that means the Federal Reserve is going to do three-quarter point. And so we're in this kind of environment right now where things are churning around and we're basically trying to find direction, between a healthy economy and a healthy inflation rate. And that's a challenge. So at the moment, we're, of course, being more defensive. This week, it was a nice up week and what have you, but we still are at the same level we were at a few weeks ago and bouncing off of that overhead resistance, and there's some pieces that are out there. We'll have to wait and see what happens. But again, for me personally, I have three different methodologies of investing. One is in upward markets, which I have a definition for, and I'm basically trying to find the trends in those markets and ride those waves. And then we get a market like we've had so far this year, where the price is coming down and what have you. But the indicators, the leading indicators for recession are still good or going up. Then I'm doing kind of a high quality, highly diversified rebalancing concept. And then the strategy we're in now is when the leading indicators are coming down. So we have 200-day moving average coming down. The S&P 500 is below that price, and the leading indicators are coming down. And so that, to me, is a defensive posture. And we move into a situation where we reduce some of our exposure to the stock market. And that's where we're at right now. And we'll see how this, run up plays out and what have you. Did we actually establish, a few weeks ago the low for the year, or are we going to go down lower and those types of things? I do think one of the biggest threats, just to think about this, has to do, of course, with the price of oil, because it's a huge component of inflation. Almost everything that we buy and get delivered has some form of energy that is needed to get it to your door or make it. And that's gas and fuel and natural gas, oil, all these things. Obviously, those have become more expensive since the invasion of of Ukraine. And but then we saw the price drop. Went from $130 a barrel at a high to this week went down to $95 a barrel. And so that is part of the reason why the market was moving quite well this week. But yesterday, Russia set up a situation where they essentially forced Kazakhstan to cut back their production 1.5 billion barrels a day. And we saw the price jump again today, I think about an 8% last time I looked, jump from that low point. And I think this is the biggest threat. Russia has this ability to weaponize oil by cutting back the delivery of that oil to Europe specifically, and that could drive price up dramatically. And if we're all paying more for gas and for diesel, whether that's shipping something across the oceans or just driving to work, that money is no longer being pushed into the normal economy. It's all going into this energy sector, which is good for energy stocks potentially, but not great for the economy. And it will cause high inflation. The Fed might respond negatively to that and lower rates even more aggressively. That could kick us into recession. So that's something I saw this week that I thought was very important. I don't think it was reported that well, but it is, I think, one of the biggest threats as to what's happening. Perhaps if Russia cuts back, Saudi Arabia picks up the slack and increases their production I'm not sure if that's possible, but there are things that happen in the oil market that are very complex. So, we'll see if this actually plays out. But a very high oil price at 160, 250, whatever it might be, would be detrimental to the stock market because it would be detrimental to earnings, and it would be detrimental because the Federal Reserve would probably continue to be aggressive in their lowering of rates, trying to drive down demand in general in the hopes that that brings down the demand for energy, right? So those are the things we're kind of watching for right now. We're, sitting at this particular point, and we'll see what happens. I do think next week will be very interesting. Do we break through this? We have now hit this level of resistance for the second time, and so the more you hit it, the more you dry it up. We could jump through this and go higher, or do we kind of fall back down? Maybe the CPI report next week being better than expected, or at least lower than May, would cause a catalyst to get us through this resistance point and move us up. The next resistance point is that little grouping that we had about a month ago, So that, we'll see how this plays out as far as that goes. And it's long ways to go here this year, and see what happens. But appreciate very much, everybody spending some time listening to my summary this week. Really look forward to being able to talk to you again next week about kind of what I see happening out there. It's a great time to be paying attention. There's a lot to learn right now about the interrelationships that drive stock market gains. Some of them aren't that obvious, where good news is bad news, etc. It's really fascinating how every environment has its pieces. But the more you watch, the more you learn, the easier it is to kind of be at least calm during some of these downturns, if not being able to take advantage of them. All right, Ethan, we've got some questions. Let's cover some of these and see if we can help some people out.
So our first question of the day comes from John. It was an email question. Do you still believe stocks is a good quality investment? I watch your show several times a week, and it's been a while since you mentioned it.
Yeah, so what he's talking about is the iShares Semiconductor ETF. The symbol is SOXX. That's pretty much what we call it all the time. So it just means the semiconductor. It's a really nice one. It has, I think, 35 different semiconductor companies in there, across a fairly broad range. It's all U.S. Based companies as far as that goes. Not positive on that. Might have Taiwan Semi in there. Anyway, nonetheless, it is a piece that we've had in the portfolio all year up until recently. And so to answer John's question, no, we do not have that in the portfolio now, and here's why. There's 3 different market strategies that I use, right? So the first one, great example, 2020. Markets flying upward. We have a broad, diversified portion of the portfolio at all times, like the Vanguard Total Stock Market Index, et cetera. Then I use these targeted indexes, and I'll actually use more targeted indexes in these big upward moving markets because I want to try to capture more of the little waves that are going on. That are happening there. So 2020, it was innovative technology, genomics, clean energy, that type of thing. That's where the money was being made. So we had that, and then we got into a market like we've had here in 2022, where the market starts to come down, right? Falls below the 200-day moving average, but the leading indicators for a recession have not triggered. So then I want to have a portfolio of well-diversified pieces, less targets. So I have, for over the year, real estate, the semiconductor index, Microsoft, and Apple, for example, is my 4 main targets this year. And what I want to do then is on these big dips, when things stretch to the downside, and I have some specific measures that I use, I want to rebalance. And so stocks was doing the worst all year. It's been a pretty big sell-off in semiconductors. Even though the demand is extremely high right now, the expectation is that the demand might be falling off, and so they're starting to sell those off. But I was looking at that from the standpoint I want to buy those low, right? But once we get into a situation where a recession is looking imminent, and that leading indicators are starting to show that, and we have the market coming down, which is obviously happening, that's when I start to get defensive. So we remove the SOX piece, remove the real estate piece, essentially. Now we have that going into an inverse component. We took out a large portion of our diversified portion to move into a T-bill type strategies, just to park the money and just essentially reduce the overall exposure. Because buying on the dip when the market falls another 20%, if that were to happen, doesn't make any sense. So this is a period of time where you just want to be defensive, let the market kind of come to you and see what happens. Now, we could be wrong, right? I mean, we just had a pretty good upward week. Maybe we have another one next week. Maybe we don't come down any further. Maybe we already established the low back, a few weeks ago, and we'll have to adjust the portfolio for that. But that's why we don't have that in the portfolio right now, just because, again, it's a higher volatility piece. I love that in a market where I'm rebalancing because I can buy more and more. I don't like it in a market that could come down a lot more. And again, if you look at the stats and you look at what has happened historically, once you get past a 20% downturn, the recovery times get substantially longer, and you could be in for some real trouble there. So this is just a point where I'm going to be more careful. But I do like that index. I probably will get back into that index. I think the long-term, viability of semiconductors is awesome, and we'll see what happens.
Yeah, so if the time horizon was kind of different, saying you're like an individual investor, you're okay with the volatility, and your time horizon's 5+ years, do you think stocks is still a good investment?
Yeah, I do. And that's one of the challenges for us, as practitioners in this business. Got 270 households. Everybody's got a different timeline, different opinion, different way that they want to manage the money. But for the most part, our clients, appreciate the consistency. And so that's one of the things I strive for all the time. Try to consistently, at least match or slightly beat the markets and those types of things. Versus having that, big rundown, because semiconductors done much worse than the market so far this year. If I look at, SOX versus VTI for the total stock market index, for example. And so, I don't want to continue that ride for too long if things are going to, because again, my analogy right now is we're standing on the edge of a cliff. If you look really closely historically at what's going on, we're right on the edge of a cliff right now. And so we're safe. We haven't fallen off the cliff. No problem as far as that goes. But the risk level just jumped dramatically because we're so close to the edge of the cliff. And so what I'm going to do is put on a parachute. I'm going to sell some of my more volatile positions or pare them back. And I'm going to get some inverse and some T-bills and things like that are basically my parachute. And I want to be able to use that to buy back in at some lower point if the market does go off that cliff. If we don't go off that cliff and we back off, then I'll kind of get rid of the parachute because you don't need it, and move back into sort of a normal thing. So theoretically, no matter how old you are, if what I'm talking about happens, in other words, the market goes down 35%, another 15% from here, I don't know if you're 20 or you have a 5-year outlook or not, if I'm right, you won't have to suffer that extra downturn on SOX and we can buy it back at a lower point, right? That's the theory. Doesn't always work, but more often buy and hold works, right? So that's why, generally speaking, if you have a longer term outlook, that works. Yeah, you could keep it as far as that goes or continue to buy it. I personally have a very long term outlook, and I personally will buy all kinds of things all the way down. And just because I don't need the money, I plan on working till I'm 75, that kind of thing. And so, but I'm a much more aggressive investor personally than any of my clients are, and that's okay.
Yeah, it's you never want to catch a falling knife. You may grab the handle, but you may also get the blade, and that's going to not be a fun experience.
Yeah, that's right. It's good analogy.
So our next question is, why is the market going up as recession fears increase? You talked about how good news is now being taken poorly by the market. Can you explain that a little bit further?
Yeah, so recession fears are going up, and at least this week and even last week for a part of it, the market's going up. And so it doesn't make sense. I mean, so much of the news that is coming out is pointing towards more recession. So many of the analysts and different people that are out there that talk about the market are talking about recession more and more. I actually think recession on Google search, trend jumped dramatically, right? So people are looking it up. And here goes the market to the upside. So there's a couple of reasons that could be happening. First of all, it could just be a counter move, right? So in other words, if the major trend is down, which it is now, and for me, one of the ways I look at major trend is the 200-day moving average. So when that's down, to me, that means the major trend is down. And so it means is that the bigger move is on the downside, and you can get these minor moves or counter trends. So we could just be having a counter trend. We've had, I think this is the fourth one this year. Market's down, 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 but we've had 4 up trends. So the minor trend so far this year has been up. So that could be one reason. It's kind of irrelevant to the recession or anything. It's just kind of the way it works. So many people get negative at some point in time that they've already sold out. The only people left are the buyers. They come in, a smaller group, but they can move because there's nobody else to fight them on the other side. Eventually that price gets up high enough and some more people sell off at those, use those points to kind of lighten up more and more, right? And so, that's why we've had failures on all of these run-ups. So that's one reason why the market could be moving up even though the recession talk and thought process and indicators are more aggressive. A second reason that the market could be moving up is just because the market looks forward, right? It looks 6 to 18 months. And so one of the things I keep reading about is that there's now some expectations that the Federal Reserve will raise rates so much that they'll slow down the economy too much, and they'll actually be lowering rates by this time next year.
Whoa.
Right? So 12 months from now. So the market's going to start moving up on that basis. Now, that parameter might fail, or get readjusted, and people realize that there's other things happening or what have you. And maybe they won't be lowering rates till 2025 or, whatever might happen. But that is one of the calculuses that's happening right now. If you read the articles, there are a lot of people thinking that the Federal Reserve is going to have to shift to the other side and start to reduce rates. And that's usually good for the stock market. And so the stock market's starting to respond to that now, right?
So is that why growth stocks are running a little bit more than value? Because as the prediction of interest rates coming down means that these companies are able to grow a little bit better.
That's exactly right. So, because we've seen growth stocks struggle here as, rates have come up and as, interest rates have gotten higher and higher due to higher inflation. So just the opposite would happen if they start to lower, rates next June or something. We'd see, obviously the technology stocks doing better. So we're already seeing that run happen, at least this week, right? I mean, we've seen the NVIDIAs and the Apples and what have you outperform the market pretty heavily this week. There's some other things too. I mean, it is this concept of the dip buying is much more prevalent than it used to be, and it's especially prevalent in the group that became involved in the market since 2020, and they're pretty aggressively buying on these dips and continuing to move up, and they're moving up the same stock. So even when it didn't make sense for technology to run, in some of these run-ups we've had earlier this year. Technology has often been the lead. So there is a group that really wants to buy those stocks, whether they're the ARK type funds, right? They have the big runs in these time frames, or the stocks that are in those, or Apple, Microsoft, Google. Some of those have had some big gains here in this last couple of weeks. So sometimes it's just that there's a group out there that is small, but very powerful when nobody else is playing, right? So it's there's a lot of reasons it could be going up right now, and whether it holds up is, I think, more important as far as that goes, because we're now running into resistance right where we are now. There was very light resistance for what we ran through, so that's pretty easy to move up. But now will it get past that? What's the catalyst to jump us through that resistance? And then we have another big jump of light resistance, so it could jump again. But then there's actually a really big resistance point above that. So those are the things we have to see a true bottom that happened, back a couple weeks ago. But yeah, it's a good question.
So more of a planning question. Does my budget ever change in retirement? As I get older, I expect to travel less, and should I plan around just having a lower budget when I get old in my advanced years?
Yeah, we have not seen dramatic decreases in budget based on age, mainly because people have a certain lifestyle and a certain amount of money to spend, and they continue to do that. It just sometimes the money goes to different places. So exactly what the question talked about, for example, with travel. So oftentimes we'll call it early travel and late travel, and we'll have 2 different budgets for that. So first, whatever number of years of retirement, a lot more money for travel, and then after age 80 or something, or whatever it is. This is personal. I have clients that are way over 80 traveling a lot, so it depends. but theoretically, we have quite a few clients that will reduce that budget. But it's often offset. So as you get older, there's more things that might happen. So, for example, maybe you need to pay for hearing aids, or more dentistry cost. Those are things we run into quite often, right? And I've seen older clients that have excess money get a lot more charitable, either with a family, right? Gifting to family members. So maybe some of the money that was going to charity is now going to their son, daughter, or whatever for Christmas, gifts, or not gifts, but, money gifts, or their other charities, that
Yep.
they're getting into. So I haven't seen a big drop off in the overall cash outflow per se, because that can be offset by some of these other things.
Yeah, a lot of people just like having that one number, one budget number, they just stick to it and they know that works for them. And we'll throw in other expenses a lot of times in the plan. So, hearing aids, dental work, those are some things that Medicare tends to not cover or covers but not enough. And so we'll see that out of pocket, you're gonna have a little bit extra cost.
Yeah, it's going to be offset by medical, that's for sure. But it's a good question actually. Because it goes in tandem with the whole life planning component of the retirement plan that I think is really important to kind of understand. But I've done about 6,000 plans. This is my 35th year. I've walked through 35 years of watching how these plans play out. I personally haven't seen a big drop off in expenditures based on age per se. Not on an average basis, that's for sure. There's always one-off situations or unique situations, but no, that whatever money's coming in tends to go back out that they're used to spending for
Yeah.
something.
But we've also seen, some people or like some other planners have what they call the go-go years, the slow-go years, and then the no-go years. And
Yeah.
if you're like an avid traveler and you're going to travel really hard in that early retirement phase, maybe that's something that you want to talk about with your planner is that, we want to be really aggressive in our early years with our budget.
Yeah, and see how it plays out. Does it work? Because it's one thing to want to do that. It's another thing to go broke. So
Yeah.
So you want to make sure it works, and if it does work, I think that feels great, right? And then you look at it every 6 months, like we do in the strategy sessions. Make sure it's still working. Markets change, things change. But I think there's a big comfort there personally that if I knew, hey, I'm spending a lot on travel this 5 years after retirement or whatever it is, but I can do it. It works. And again, I'm checking that every 6 months to make sure, but I feel good about that. And I think that enhance the travel. I mean, personally, if I'm going to spend some massive amount on travel, I'd like to know I can afford it. Because if I am worrying about whether I can afford it or not, at least in the back of my mind, it takes away from the benefit of the vacation. And the
Yeah,
travel.
are you going to pinch pennies here, like
Right.
on a meal or stuff like
Right.
that during that travel?
Right.
Are you going to get guilty that, I can't buy this souvenir because
Right.
it's a bit too expensive?
It's nice to know. I think that's one of the powers of what we bring to the clientele is that, retirement plan and using Monte Carlo simulation, we know, and then we can keep adjusting and keep looking to make sure that what we know is still accurate. But it's really, I think that's super important, personally. For me, I would struggle, to not have that structure there and just guess what I could spend.
So our next question is, why is oil crashing? We've seen this week where it's just been kind of dropping quite hard compared to where it was a month ago.
Yeah, so I think the biggest reason oil has been coming down, because it actually hit $130 a barrel as a high, got down to $95 this week, give or take. And really what has been happening is that there's a fear of recession coming as the Federal Reserve has been more aggressive in their conversations, as we're seeing more softening, in the overall indicators that we see, new homes, building permits, applications, mortgage applications. So housing is looking like it could soften up, all those things. So when you have less economic activity, you use less energy, right? And so the price of energy comes down in recessions. And so we've seen that. As a matter of fact, it's been pretty dramatic. Just in the last month, a lot of these ETFs that have energy stocks in them have had a really bad time. A really good year altogether.
Yep.
Still, even with that downturn, but big downturn. And so that's why, although, please keep in mind, if you look real closely, just at the last couple of days, we had, Russia, essentially Russian courts had cut off 1.5 billion gallons of a day, sorry, gallons, barrels a day of oil production from Kazakhstan. And we saw a big jump. We went from 95, I think it's up to 105 now or something along
around
those
that.
lines. And so, that can change very quickly. And it's one of the problems with investing in oil or energy, in my opinion. Okay, Russia starts to get aggressive and cut back on production in different ways, even their own production, make less deliveries, price starts skyrocketing. You start to see those ETFs, moving up, like Vanguard's Energy, VDE, or whatever. And then all of a sudden, Saudi Arabia comes in and starts to, talk about increasing production, or China starts to more and more because this BA.5 Omicron variant is running around. They got their zero COVID, and all of a sudden, boom, you start to see a slowdown because China uses massive energy, because they're a huge producer. So if China locks down, they're using less energy, oil starts to come down. There's a lot of inputs into energy. It's why I don't really prefer it as an individual target. I have used it a few times, but it's really difficult one to use just because of what's going on altogether, right?
Yeah, and like Kazakhstan could eventually come back online. It's just going to take some time. They're not, the pipeline's always going to be the easiest way to transfer oil, but there's other ways. And
Right.
if countries are willing to invest, and I think countries at this point are going to invest in alternative routes that kind of exclude Russia.
Yeah, and exactly, whether that's getting oil from other countries. And some of it, like liquid, like gas, is a tough one, because most of the big gas comes through pipeline. They can do liquid, liquefied natural gas, LNG, and but you got to have a certain port, to capture that from one ship onto the port, and so those have to be built. So the U.S. has surplus in natural gas, but getting that to Europe, it'll happen actually. So that'll be one of the alternatives that come. The U.S. will start to produce more gas for Europe than we are now and ship it across, but it just takes time. And so they have a December 5th cutoff for Russian energy. I don't know the exact parameters, but they're cutting back in Europe on a very aggressive basis on the Russian oil, natural gas, and coal. And so that's going to create a big restriction in the market because they're going to be going other places to get that. And so, we'll see how that plays out. So that's why, even if oil is crashing, I actually think oil is one of the biggest threats to the stock market right now because of what could happen as Europe starts to push away from Russia, and potentially as Russia starts to use that as a weapon to push Western economies into recession by making oil $160, $250 a barrel. Yep. That's a pretty good weapon. I'm surprised it hasn't happened yet, and there's probably something I don't know about that doesn't make sense, and that's why
I think the other producers would cut in. If you give me $200 a barrel, I'm gonna find a way to get more oil out there.
Yeah, but even that might take time. I mean, because they've had some troubles getting things restarted. Like here in the U.S., there's an awful lot of oil pumping that hasn't restarted yet. Even if they want to, there's some issues, and oil's got this weird thing going on where people are afraid to put big money into it, which sometimes is what it takes to refine it and pull it out of the ground, because they're afraid that clean energy is going to be a big replacement. You got states like California saying you can't buy a new gas car here by, I think it's 2035 now. Originally it was 2030. Other states have followed along, and you've got China trying to become energy independent, which means a lot of clean energy by 2060. If you've got a big investing pool that wants to put money in to drill or restart, it takes money. And there's less money coming in there because of this fear of because the payback usually on those investments is so long.
Yep.
And so do we really have that long? If the payback is 10, 20 years, where will oil be in 10 or 20 years versus the clean energy, the battery storages, and those types of things? So it's a tough environment right now to figure out what's going to happen there. There's a lot of different things going on. It's really, really interesting.
Our next question is, my portfolio is down. is now a good or bad time to start thinking about conversion of my Roth
Okay, so
or to Roth?
let's say I've got an IRA, just to make up a number, $100,000 in the IRA, and I want to convert, say, 50,000 because that's all I can afford. I've got enough money to pay the taxes. That 50,000 is, not enough to push me into a higher tax bracket. So maybe I stay in the 22 or the 24% bracket on the Fed basis. So when should I do that, right? So theoretically, when the market's down, like it is now, is a better time, because if the market rebounds, which it will at some point in time, that 50,000 could grow to 60,000. I'd rather have it grow tax-free in my Roth back to 60,000, get an extra $10,000 tax-free, than have that 50 grow back in my IRA, because now I got another $10,000 of taxable income in there. It's nice to get the growth, but I'd rather have that growth tax-free because it's worth more.
Yep.
Yeah, I mean, a fair amount more. So, but there are some caveats. Number one is this the lowest point?
Yep.
Right? I mean, okay, down 20 or whatever it was, is that the point to do it? Because there would have been lots of points so far this year. You say, well, that looks pretty low, and it turns out it wasn't the low point. And so you might look back and say, wow, I wish I would have waited. I guess the way I look at that is just, you can only really look at where you are today. And knowing where the thing's going to go tomorrow is kind of a fool's game, at least, especially when you're looking at a conversion of Roth.
Yeah.
It's lower.
Mm-hmm.
And when it recovers, you'll make money, right? So I probably do it for that purpose. But there's some problems with it, right? There's some issues. So if you're over 72, you have to take a required minimum distribution, right? In order to do your Roth conversion, you have to take the required minimum distribution first. Okay, so that's kind of complicated. So what that means is the market's down, and the number is fixed based on this value at the end of last year, which was higher. So let's say I have to take 10,000 out of that $100,000, which would be a lot, but bear with me. I'm actually having to sell more shares to get that $10,000 out now than I would have at the beginning of the year. And most of the times we do it at the end of the year because on average the market goes up, and that 10,000 might grow to 11, and I can leave that extra 1,000 in there. But now I want to do this Roth conversion. Well, I'm going to have to take that 10,000 out at a low point. But I'm converting 50,000. So if I'm having to take out 10 for RMD and converting 50, again, we're making these numbers up, but that's still a win, right? So it kind of depends on how big your required minimum distribution is and how big your conversion is, right? So I'd look at that. The other thing is that I have an awful lot of clients who are giving to charities out of their required minimum distributions. And so it's called a qualified charitable distribution, QCD. And so these basically allow you to send directly out of your IRA money to a charity. It's really cool. And none of that ends up in your tax return. So if you had to take 10,000 out, you could write out checks out of your IRA, for example, for $9,000, and that won't end up on your tax return, not taxable. So that's nice. And then you take the other 1,000 out and meet your requirement. But again, if you're going to do a required minimum distribution and a qualified charitable distribution, all of those have to be done before you can do your Roth conversion. And so that can kind of complicate the math and even just the logistics. Which charities do I want? Sometimes people are still deciding, that kind of thing. So I still think it's all worth it. I think it's worth the hassle to figure that out. I think it's probably worth, in most cases, to take the RMD early, even though it's at a low point, because you're going to gain more theoretically on that conversion. Maybe the market goes down and it looks like a bad idea, but eventually it comes up. We have to believe at some point the market's going to go higher than where it is today. You just, you look at the highest point prior to the crash of 2008, we were way above that. So, the market does make money over the long term. At least it has, in the past history. So, I would probably look at Roth conversions in these low points as a good thing.
Do you ever think about the idea of, say, let's do a portion? Let's not, I can do 50,000, but maybe I just do 25,000 right now. And then maybe towards the end of the year when, even if the market's higher, I'll still do that 25,000, but maybe I'll try and take advantage of this downturn.
Yeah, it's sort of a dollar cost averaging backwards, right? I mean,
Mm-hmm.
yeah, that works, right? So it's a little bit of a cumbersome thing to do it like every month or something, but like you just said, 2 transactions, that makes sense. So you do half of what you thought you could do now, wait and see. Market goes down lower, you'd be happy, and okay, do the other half, or the market goes up more. Well, probably should have done all of it before, but you don't know where it's going to go, so you're splitting the difference.
Yep.
That's the same way when we're dollar cost averaging buying, right? And that's a very powerful strategy to do. So yeah, I think that makes some sense too, as far as that goes. There's no problem, no problem with that. I mean, another way to do it too is that maybe you decide to do more if it goes down. So 50 works, but you still had room. Most of the times when we do it, there's quite a bit of room still under the next tax bracket jump, right?
Yep.
So maybe you do the other 25 on top of that if the market goes lower too. So yeah, there are a lot of different ways to do it depending on your situation, how much money you have to pay for taxes. All of those things are factors in what to do there. But it's a really good question, and it's been coming up, because the market's down now as on a regular basis. So it's a good thought as far as that goes.
Yeah, so one final little question is, I keep checking my portfolio. Do you have any advice or how often I should check? I'm starting to stress out about, if I'm checking on a daily basis and it's stressing me out.
Yeah, I've had clients that's happened to actually. So they maybe download the prices or the results every single day, and it dominates their evening based on what happened with their portfolio. I would say if it's stressing you out, there's 2 things I would think about there. Number one is, do you have the right portfolio?
Mm-hmm.
Right? Because you check portfolio every day and it's doing what you really expect and it's within your risk tolerance, and you're like, okay, I was expecting this. It doesn't matter how much you check if you have the right portfolio.
Mm-hmm.
Okay? So that would be my first thought. If you're telling me that you're really nervous because you're checking every day, first thing I'd want to do is really dig in to your personal risk tolerance and try to figure out what's going on. Because a lot of people in upward markets keep moving up in risk because they want to get higher returns, but they don't really get the true ramifications of what happens when things fall. We try really hard to convey that. And so the reality of it can sometimes be, whoa, So if somebody is talking to me about being stressed, that's the first thing I think about. Is that portfolio right for this person? Should we be reducing stock market exposure to find the right one? So maybe they're at 80% stock and they should be at 60% or whatever it is. Then the next thing is, I think that's just more of a personal question in the sense that you got to find the time frame to check your accounts based on your own personal desires. And again, I'll give you an example. So most of the times when we're talking about portfolios, they're these large diversified things.
Mm-hmm.
Not everybody has that. I mean, you got a basket of ARC-type stocks, these innovative technologies. And I mean, if you watch that once a month, I mean, if you have a really long-term outlook, you're probably fine. But you could have a 60% drop before you know it. So it kind of depends on how active you are or how active the holdings you are. But if you have a normal portfolio like we use, what I would consider normal anyway, but then it's more of a just personal preference. So maybe you should be checking, on Fridays or Saturday on the weekend, or instead of every day or once a month, or just look at your statement as it comes out, and those types of things. Especially if somebody else is managing the money, then maybe it isn't as critical to look at it every day. I look at it constantly. You're asking the wrong person. That's my job. I have 6 screens. I have, one of them's by the minute, and one's 5-day by the 10-minute, and 30-day by the hour, and 3 months by the day, and et cetera. I mean, I look at all of it. I go through the holdings, and I want to see what's going on. We get pretty good reports that we put out here in the practice to see how we're doing versus the market with our models. But that's what we do for a living, and it doesn't stress me out. I find it very interesting, even when the markets aren't bad or are bad like they have been. I still see opportunity, which I'm thrilled with opportunity. Anyway,
Yeah, and that's one way of framing it is, if I'm still adding money, I'm getting something cheaper than it was before. And
Yep.
if I still think it's a good quality like investment, getting it cheaper is not a bad thing.
yep, that's right, exactly right. That's it. All right. So we had a great show today. I'm so happy everybody could join us. Again, you can send in your questions at any time. So send them in for next week. We will answer them like we did today. And you can watch that and we'll, get that set up for you. Or you can obviously subscribe to the channel. Education about retirement is really important to improve your chances of a great financial retirement. And you can subscribe by the subscribe button. Obviously, hit the little bell to get notified, or book an appointment with us. And we'll be happy to talk to you. Go to the website, hit the book appointment button, pick a 30-minute phone or video time for Ethan and I to sit down with you, and we'll figure out what we might be able to help you with. So appreciate everybody listening today, and I look forward to being able to see you again next week. Thank you.